Thank you everybody. So today I will present to you, my presentation is going to be about fraud detection for insurance companies, specifically claims with body injuries element attached to them. So the key takeaway of my presentation, I'm going to give it to you right now, is that AI algorithms, they are powerful tools, but they're greatly, in my experience, they greatly benefit from enhancement and insights with scientific literature, and in my case, economics literature. So just to give you a bit of a context, so you have the current detection process that is used in most insurance companies, and our goal is to help create a recommendation system in the triage phase. So the triage phase is composed of triage adjuster. Their goal is to decide if a claim should be fully audited or if a claim should be processed back and be treated normally. So the problem that those guys face is they have only 15 minutes to decide if a claim should be fully audited or not, due to the sheer number of claims that is produced by an insurance company per year. And the idea is that an ML classifier makes a lot of sense because it produces a fraud probability tirelessly, consistently, and it's able to produce it by analyzing a huge amount of data that is unable for a human to process within 15 minutes. However, it just only does this. It just creates a fraud probability. It doesn't create a recommendation. It just attaches a fraud probability to a claim and tells you, okay, this is the probability that you claim is fraudulent. So this is where the economic literature can really shine. So here, specifically game theory literature. So I present to you the sequential tree that you have here. And so the sequential tree models the relation and the game that is played between the claimant and the insurer. And so the tree starts by a state of nature. Given an accident or no accident, the claimant, which is the first player, will decide whether he's going to fraud or not if he has no accident, or whether he's going to claim or not if he has an accident. And then the insurer subsequently will decide to modify his audit policy or not. And so there are lots of key insights here that can be captured from this tree to help create a better recommendation system than just using ML algorithm. One key insight, for example, is the relationship between the audit policy and the fraud rate. The basic idea behind this is that if the insurer increases his audit policy by marginally by, let's say, 1%, you are expecting to see a decrease in the fraud rate subsequently because the audit policy will be higher. And so this deterrence effect, it's a deterrence effect, by estimating these deterrence effects, we're able to target specific groups of claimants that are more likely to fraud versus other groups of claimants. And so $1 spent to audit those groups of claimants will be more efficiently spent than $1 spent against another group of claimants because the deterrence effect will be higher. Another key insight that can be taken away from this sequential tree is the equilibrium fraud rate. So the equilibrium fraud rate allows us to to have an idea of what is the global fraud rate that should be observed given the payoff that you see at the end here. So those payoffs, they determine essentially the global fraud rate that could be observed for a group of claimants given those payoffs. But they don't tell you which claim within those groups of claim is fraudulent. And so this is the part of the machine learning algorithm. It tells you which claim is fraudulent. And the problem is that our label data, we know that there are some zeros that are 1 because we haven't detected all the claims. And so estimating the global fraud rate gives us an additional insight. And again, it helps us create a better recommendation system because we are able to target, let's say, groups of claimants that we know have more residual fraud that we do not know about using those kind of model. And indeed, when you incorporate machine learning models and those insights from game theory, you are able to really outperform cost-sensitive. So cost-sensitive algorithms are essentially a recommendation algorithm only based with machine learning algorithm. So they don't incorporate all those economic insights that I presented earlier. And when you incorporate them, so this is the column in red, you see that we are able to perform others traditional or more just ML-focused classifier, cost-sensitive recommendation system. But we can even go further. We can even try to do some feature engineering using economic literature. For example, we can try to estimate the risk aversion And I will stop there, I think.
Yeah,
Okay. So we can try to estimate the risk aversion and try to use it as a feature within the classifier and see how good the prediction is improved. And the risk aversion is also, you can define it as a way of how the claimant feels to be in an uncertain state. So if he chooses to fraud, he chooses to be in an uncertain state, he relinquishes a certain state to an uncertain state. And again, groups of claimants with higher risk aversion are expected to fraud more than groups of claimants with lower risk aversion. So you can enhance further the recommendation system. Thank you for your time.